Does the S&P 500, which is market value weighted, does it give you really the best view of the market, or is it a skewed view of the market?
Yeah, it's a great point that Bob brings up. And look, in the near term, we do think that this tech trade could persist. It probably does have some legs. And there's a couple of reasons for that. One, of course, when you look at the breakdown by sector, there's only three sectors that are outperforming the broader S&P 500. Those are, of course, comm services, technology, and consumer discretionary. Two of those are back in bull market territory, so up 20% plus. So when you look at the technical picture, in fact, those growth tech parts of the market are above their 200-day moving averages. For the most part, the sectors are driven by technical momentum. And so there is some support, especially in the near term. The other factor we'd point to, if you look at what investors are doing now, they really do have an alternative to equities. They can sit in these cash-like instruments that are offering 4 to 5% yield. And what would drive them back into the market? Well, they really have to see interesting opportunities. Perhaps it's AI that's motivating them. Perhaps it's proven business models, strong cash flows. A lot of those large cap tech names this earnings season announced another set of big buyback programs. So they're returning value to shareholders. So we do think that this trend can persist, especially as the Fed keeps rates elevated and elevated for an extended period of time. And the final factor I'd mention briefly is that, usually what happens is after an economy goes through a downturn and as we enter a recovery phase, that's when we see broader participation, small caps, cyclical parts of the market, even international and longer duration bonds. We haven't gone through that process yet. So there is some room to run, we think, for this trade. But as we look 6 to 12 months down the road, keep in mind the broader participation we do think comes back to some extent.
Let's talk about what's been happening in the past few weeks. The major market indexes have been down for 4 out of the past 5 or 5 out of the past 6, whatever it is. And in the past couple of days, those indexes have turned a little bit, presumably on hopes of a budget deal. What do you expect the major market indexes to do as we move from spring into summer into the fall?
Yeah, look, I think if we do go through an economic downturn, and our base case continues to be for a mild recessionary environment, that is now a consensus view, we don't think markets can completely ignore that. In fact, we probably will get bouts of volatility. We do think more recently, better optimistic views on the debt ceiling, better news overall on the banking crisis has supported markets. But if we start to see an economic downturn, markets can't ignore that. But keep in mind what we went through last year and really over the last 16 months, S&P drawdown of 25%. We've been in this bear market territory. Markets will start to look forward. In fact, market cycles and economic cycles are different. So if the economy is moving downward, markets can move upward in advance of a recovery. And so that's what we think happens. We do think period of volatility is that opportunity to position for a recovery phase. And that recovery phase, we think, will be led by broader based leadership as well.
Mona Mahajan, Edward Jones, thanks very much. We appreciate it.